Hello and welcome, everyone. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and this is Trading Places Live. It's Tuesday, January 17th, 2022, and I'm pre-recording this Trading Places Live for just a little bit later this morning. Currently, we see futures are down. Dow futures down 109 points. S&P 500 futures down about 10. NASDAQ futures down 37. On a percentage basis, they're all within about a quarter to 1/3% lower. Crude oil prices this morning up about 0.75%, back up over $80 a barrel. U.S. 10-year Treasury yield up 5 basis points this morning, 3.56%. That's where we're going to get started. Let's go ahead and walk through today's agenda. We're going to start off with the daily market recap. Talking technically, volatility. Going to take a little look at that VIX warning sign that it had given us probably close to 2 weeks ago. That has certainly worked out in the bulls' favor. Earnings spotlight, and then we'll wrap up with the 3 you must see. Before we get into any of that, though, let me walk you over to earningsbeats.com. If you go to earningsbeats.com, scroll down, we do have a free newsletter. This is a newsletter I publish 3 times a week, Mondays, Wednesdays, and Fridays, normally out about an hour before the market opens, so about 8:30 a.m. Eastern time. It only requires a name and an email address, no credit card required. You can unsubscribe at any time. Make sure you head over to earningsbeats.com, fill that out, and become a subscriber. Keep in mind that all of our subscribers are invited to our free events, and we do have a number of those. We had one last night, which was a sneak preview of Q4 earnings, looking ahead at some of the earnings reports that were due out, and based on relative strength, determining whether or not we should expect good reports or bad reports. We've done that in the past. We've done studies, and honestly, I don't know that there's anything better than relative strength when it comes to predicting whether a company will beat or miss its earnings expectations. As you can see, our history with our portfolios, we have done really well over the lifetime of our portfolios. If you click on that historical performance button, you can come back here and check these out. Both our model portfolio and our aggressive portfolio are ahead of the S&P 500 this quarter. Just keep in mind that this quarter is based on the November 18th to the February 19th quarter. It's not calendar quarter, so it's not year to date. But doing pretty well on both model and aggressive. Income portfolio down this quarter right now, and also down since inception. Of course, we've been in a secular bear market for most of the past few years, and as a result, income stocks don't do quite as well as their growth counterparts. But model and aggressive is set up for growth, and you can see both, especially on that inception to date basis, doing extremely well. Our model portfolio is up this quarter, and this is a little different quarter. We run our model ETF portfolio from October 19th to January 19th, so that will end this week, and that is why on January 18th, tomorrow, we will be having a members-only model ETF portfolio draft, where we go through and talk about the themes, what's going on in the market, and then show you the model or the ETFs that are going to be in our model ETF portfolio for the next quarter. And we got a really unique way of looking at these ETFs. It's our ETF analyzer spreadsheet. So we take a look at the most relatively strong ETFs for the most part. Look at themes. Look at the stocks within those ETF portfolio or within those ETFs to see if we like the ETFs. And if we do, we put them in our portfolio, and then we compare. Once we've listed all of our portfolios or all of our ETFs in the portfolio, then we'll take a look to see how well diversified we are and compare that to the S&P 500 weightings by sector. So, my thing with ETFs is you just need to know what you own. You just don't go out and buy an ETF. Someone's sitting at the water cooler says, hey, this ETF's been great. Last few weeks been doing super, and then you just go out and you buy it. You don't even know what you own. Walk through me tomorrow night with the this ETF analyzer, and I think you'll get a pretty good understanding of a much better way of looking at these ETFs. Anyhow, our performance, you can see, up slightly this quarter, down since inception, but there are a couple of reasons. Number one, it's hard to pick an ETF portfolio to beat the S&P because ETFs are widely diversified. And just about any study will tell you the more stocks you own, the less likely you are to outperform the S&P 500. And so, and another maybe, I don't know, I don't know if it's a mistruth or an untruth, but a lot of folks think that you have to have a lot of ETFs. You know, if you only have 3 ETFs, then you're not diversified. Well, it depends what those ETFs own. If you own the SPDR, the SPY, one ETF, you own 500 of the largest multinational companies in the world. That in itself is a diversified ETF. You could own just the SPDR, and I think you should feel comfortable. So it's not the number of ETFs that you own, it's the total of the stocks. It's all the stocks within them. So if you get a very heavily concentrated ETF, then yeah, you got to be a little careful. Anyway, we're going to talk about that more tomorrow night. If you are interested and you'd like to see how we construct our portfolios, in this case, the model ETF portfolio, then at the top of our homepage, you can see an area where you can hit that start your no-cost trial button. So you get a 30-day no-cost trial to our service, and you're more than welcome to come in to our events. All right, let's move on to the daily market recap. So going back to Friday, of course, it was a long holiday weekend, but back on Friday, the Dow Jones Industrial Average finished up 112 points. S&P was up 16. NASDAQ up 78 on a percentage basis, was the leader among these three. Mid caps up 12.5, small caps up 7. So pretty decent day just to continue the rally. Not a huge gain, but at the same time, pretty big move to the upside. I want you to check out these AD lines. The Dow easily moving to a new all-time high. S&P 500 right behind it. NASDAQ not quite to its high, but strengthening again as we start 2023. I love the way this looks. Mid caps new high, small caps new high. I mean, you might be bearish. If you want to be bearish, have at it. But market is telling us that Wall Street is once again accumulating, and we've only got one big level, in my opinion, of overhead before the bottom is confirmed. And I'll talk about that in just a minute. Discretionary stocks leading the way on Friday among the sectors, up almost 1%. Financials and materials also strong. To the downside, real estate and utilities, 2 defensive groups, were weak. Real estate trying to get back through $40, nearly did it, pulled back just a little bit on Friday. We'll see if the gains can continue as we start a new week. Utilities not quite able to take out the December high, still in a nice uptrend off the low that we saw all the way back in October. 10-year Treasury yield, at this point, like I said, in the pre-market, I was giving the numbers. Right now, 10-year Treasury yield is up 6 basis points to 3.57. So this is still showing the close from Friday, but we are up 6 basis points, 3.57. On the chart, not really meaning a whole lot. We need to get back through the moving averages. I think we have started this downtrend again to the downside. Watch the 340 level to the upside. I think you're going to need to get through both moving averages, maybe, something back above 375, 380 before it would appear that we were moving higher. All right, moving on to talking technically. The S&P 500 really making this nice move the last week and a half. Beautiful move off of 3,800. We held on to the gap support level that was established back when the October CPI came out on November 10th. The level from where we gapped up from was 37.48. The lowest we got was 37.64. So we went down, got within about 16 points of that gap support. And that came on the heels of the big gap up that we had here on December 13th, which, if you recall, was after we got the November CPI data. So both of these gap ups occurred after the CPI. One, we kept moving up. The other, we topped temporarily, came back, nearly filled this gap, and now moving back up again. I think right now what I would be looking at in terms of the key trading range on the S&P 500, I'm going to say 4110 right here on the S&P 500. I think that's key resistance. You can see the intraday moves right up to about that level as well. So 4110, if we can get a close above 4110, that not only will take out this triple top, but it also will clearly break the downtrend that we've been in since the beginning of 2022. So that's a level I'd watch clearly, 4110. I think if we get through that, I think it's going to be a really big struggle for the bears. I think the bulls will be back in control. The volatility index, which I'm going to show you in just a minute, back into the into the teens, also showing that the bulls are in control. So I'm just waiting for that price breakout and confirmation, which I think occurs at 4110. To the downside, I would be concerned if we lose that 37.48 gap support level. Now, obviously, in both cases, you can say, well, if we get through 4110, we still got this level. Well, that's true. And then we also got this level, we got this level, we got the other level back in January. I mean, you're always going to have multiple levels, but it will begin to look like, it won't just begin to look like, it will show that the downtrend line has broken. And while all of the bottom calls that I made back in the middle of June and late September, right before we got the major bottom in October, all of those bottom calls were based on other signals, not price action. I mean, obviously, you can't call a bottom based on price action. We're moving to new lows here. At the end of September, we were moving to new lows. I wasn't basing it on price action. I'm basing it on the things that were occurring underneath the surface that most people pay no attention to. And I think both of those bottom calls were pretty darn good. We're now back up near 4,000. I can tell you that at these two bottoms, I'd much rather have been bullish than bearish. I mean, if you were bearish, where's the follow through to the downside? I'm not seeing it. Bottom line, this market's done going down. We're done. We are back in an uptrend. Your confirmation comes on this move here. Now, to the downside, if we were to lose 37.48, again, to me, that would be a really bad sign. And depending on what the under the market or under the surface signals we're saying about the market, you know, maybe we'd have to reevaluate, maybe not. Maybe it would just be more sideways consolidation. But that would be a key level that I think we'd need to reevaluate. Of course, you still got this low, you got this low, you got the low from October. So you got multiple lows down below, just like you got multiple tops above. But this is the range that I think in the near term, 37.48, 41.10. This is where we want to keep our eye. And let's see what happens from here. All right. So I talked about the volatility in the VIX. I want to show you, if you didn't already see it, an article I wrote back on January 6th. And this is simply, anytime I get signals where the VIX and the S&P 500 are moving in the same direction, that normally is a signal that the S&P 500 is about to reverse. And the reason that it happens is you've got the volatility index, which is based on the pricing of S&P 500 options, short-term S&P 500 options that go out about 30 days. So the premium on these options is the expected volatility. If you're in a market where you're not really moving much, usually you're in a bullish market. Normally, that's the signs of a bull market. Bull markets are boring. You go up a little bit, you pull back a little bit, you go up a little bit more, you pull back a little. You know, 2017, we never had a drop of more than 3%. The entire year, all year long, we kept going up. We never even had a 3% pullback from the high at any point during the year. I think it's the only year that's ever happened. Anyway, that's the kind of market action you can have with a bull market. And that sends the VIX way down. Now, with a bear market, though, you got a lot of fear, you got a lot of panic, you got a lot of sudden moves, and as a result, the pricing of options is much more expensive, and that translates into a higher VIX. So anytime the stock market is going down, you normally see the VIX going up. And when the stock market is going up, you tend to see the VIX trending down. That's the way the market normally works. Well, when the wires get crossed and the VIX and the S&P 500 start to move together, in my experience, you're looking for an S&P 500 reversal. So I'll scroll down just a little bit further here so you can see the VIX and the correlation, the VIX versus the S&P 500. And if you look back, most of the readings are down near -1. Most are between -0.75 and -1, which is exactly where you would expect it, because the VIX and the S&P tend to go opposite one another, and they should. That's the way, that just makes common sense to me. But it's these moves up in the correlation when we get above zero, and especially when we get above 0.25. I'm going back all the way to January of 2020. We've had a lot of different, volatility spikes and reversals and everything else over the last few years. But only 3 times in the last 3 years have we seen the VIX and the S&P 500 move together long enough to see the daily correlation move above zero. I mean, you'll see here, we get some of these moves to the upside and then back down, but it doesn't last long. You get a spike up, you go right back down to -1. And then here you get a spike back down to -1. Here's a spike, here's a spike, here's a spike, you get some spikes where for a couple of days you might get some, movement in the same direction. But when you get a positive correlation, and this is over a 20 period, which it's a daily chart, so that's 20 days. If you get a positive correlation over 20 days, that to me is something that you need to pay attention to. This one occurred right at the major top back in September of 2020. And I wrote about that one right on that day, September 2nd, September 3rd, something like that. And of course, we reversed, went right back down. Here, we went back down. Now, notice it was just temporary. Then we went right back up again. But this, again, was a signal. The S&P was going up, so was the VIX. S&P was going up, so was the VIX. These are signals that you want to be careful of. Now, in this case, recently, the S&P or the VIX was coming down, and so was the S&P. Normally, the S&P goes down, everybody gets more fearful, and VIX spikes. In this case, the market was coming down, and so too was fear. That's important. You need to have this chart and recognize this. January 6th, this was a Friday. I wrote this article. January 5th, the Thursday, almost 2 weeks ago, I told members this was a time that we could see the S&P 500 reverse and move higher. And I even suggested, if they're willing to take on more risk, to get into leveraged ETFs on the long side. And I don't encourage that for most folks very often, but that's what the signal was telling me. The VIX was going down with the S&P 500. Fear is coming out of the market while the market's dropping. Doesn't happen very often. And it's just, I guess, from a common sense perspective, what it's telling me, the story it's telling me, is what if we get any good news? I mean, if we've got bad news, or if we got things that are sending the market down, and that's not sending the VIX higher, fear's not growing on bad things happening in the market, what's going to happen if we get any good news? Well, we saw it over the last week and a half to 2 weeks. Got a big spike. I mean, we were at 38.69 when I wrote the article, and we were down lower than that, I think 38.30 something, when I sent it out to members in the afternoon the day before. Now we're up 4,000. All as it was, it says, hey, we could soar short term. If you're a trader, listen, if you're long-term buy and holder, who cares, right? Who cares about these cyclical bear markets? You're just holding through everything for the most part. You want to be careful of a secular bear market, even as a long-term buy and holder, because you can get hammered over 10, 12 years. And if you're getting close to retirement, probably not a good idea just to keep holding through something like that. It can destroy your retirement. But when you're in a secular bull market like we're in, nobody's going to convince me otherwise at this point. The only thing that's going to convince me otherwise is for the market to go back down and break down and have something catastrophic happen in the market. But I believe we're in a secular bull market. I believed it during the 2018 bear market with the trade war, cyclical. I believed it during the 2020 cyclical bear market with the pandemic. And I believe it now. This is just more of a standard cyclical bear market. The last two were very short. Fourth quarter of 2018, hit, gone. March of 2020, it hit, gone. We're right back to our bullish ways. This one's a little different, and it's got a lot of folks a lot more bearish because it lasted so long. Now everybody thinks the market has to go down, which is awesome. That's what we wanted. Beginning of the year, beginning of 2022, I said, more than anything, we need a sentiment reset. And what I meant by that was everybody was bullish. Everybody jumping into AMC and GameStop and everything. It doesn't matter. You just buy stocks and they just go up, and the market was an ATM machine. We needed everybody to change their mind and think that the only way that the market can go is down. And that's where we are now, which is awesome for a bull. Anyway, so here was the VIX. The VIX moving down, as you can see. S&P now has turned back up. That's that move up that I was looking for. We've gotten it. And the correlation has gone back down to where it belongs, which is down at that minus 0.75 level. Long term, just beware of one thing. The 2000 to 2002 bear market, we never saw the VIX go below 17. Once it was below 17, confirmation, bear market over. 2007 to 2009, there's your lows, 16, 17. Once we got below 16, bear market was over. 2018 fourth quarter, we jumped up, came right back down very quickly. Once we were below 16, 17, bear market over. The pandemic, because it went up so high, it took a little bit longer to go down, but 2021, but once we got down below 16, bear market was over, confirmed. I mean, it was over a long time before that, but my only point is here, the VIX is going back down. We closed at 1835. History tells us if the VIX goes below 16, bears, it's over. Earnings spotlight. I want to talk a little bit about a few companies that have come out with some strong earnings so far in 2023. These aren't companies necessarily that you would think of as kicking off earnings season, because I always think about JP Morgan and the big banks. But these are companies that came out with earnings nonetheless in 2023 and had strong results, but notice not always strong reactions. And that's the thing that's hard about holding stocks into earnings season. I can give you a pretty good idea of whether a company is going to beat or miss its earnings, but that doesn't always mean you're going to get what you would expect in terms of price action. Look at Richardson Electronics, RELL. They blew away their numbers, top and bottom line. Stock gapped up. Look at this. It gaps up right here and then sells off all day long. If you chased that, if you waited for the earnings, if you held, or if you saw the earnings news and you saw the gap up, 4 or 5% gap up the next morning, and you jumped in at $22, end of the day, you were at 18. That's difficult to swallow. And then you panic probably and get out and look 3 days later, we're back up over 23. The volatility around earnings, that's why we tend to see companies' premiums, the premiums on their options go up right around earnings, because there's so much more potential for big moves and market makers price it in. But anyway, I like the stock, even though it had this crazy volatility, had a beautiful move up. Relative strength was at a 52-week high in the fourth quarter. That tells me most of what I need to know. And then when they come out and they actually deliver good results, I'm going to be looking for weakness to actually get in on stock. I think jumping in and holding into earnings, if you want to play that game, go ahead. I can only tell you, you might as well go to Vegas and put your money on a roulette wheel, red or black, because I think it's about 50-50. I've done studies, and you might have a little bit of a advantage knowing, how stocks are trading on a relative basis going into earnings, whether to hold or not. But the volatility is extreme. I can tell you if there's 20 stocks reporting and I hold 2 of them, those are the 2 that aren't going to report well. It's just the law of averages. And maybe you feel the same way. But anyway, I don't like to hold stocks into earnings. Another stock that looks really good after earnings, AEHR. This is Air Test Systems. This one gapped up after earnings and broke out and has continued moving higher. Looks really good. Conagra, if you're looking for a stock maybe a little bit more defensive, Conagra Brands. So we're talking about food products company. AD line looks great. Look at the price action here. Pulling back, trying to get close to that gap support area. Relative strength right here versus its peers. Literally off the chart, 52-week high. So Conagra looks good. Lamb Weston, LW, another one gapping up, looks really good. One of my favorites coming out after the earnings season so far. I would say this is one of my favorite reports. It's in the steel area, so in materials. This is commercial metals. Big move up, and it has continued strengthening after it came out with much better than expected results. And then we got one like JP Morgan, like we were expecting. Look at the relative strength on JP Morgan heading into its earnings report. They blew away the numbers and gapped down at the open. That probably scared some folks out, but look what happened when it hit the 20-day moving average. Complete reversal. Beautiful day on Friday from JP Morgan. Couple that reported today, Morgan Stanley reported. I think Morgan Stanley looks pretty good right here, 52-week relative high to the investment services group. And after hitting that, went into like a little cup. I think maybe we formed the rest of this cup. I think stock was up about 1% pre-market. Another big one that reported was Goldman Sachs. Goldman Sachs actually missed its earnings estimate, which was surprising. AD line looks good. I thought relative strength, which also hit a 52-week high. This was back in November. That's when it hit the high, the absolute high. And I think it's just been consolidating. What I told members last night, actually the public, we had a public webinar last night on earnings. Goldman Sachs, I liked the stock. I said if it did beat on both top and bottom line and pulls back into the 350s, I would like it there. Unfortunately, it missed on earnings, so I want to reevaluate. Let's see how it trades. But it was down, I think, to about 367 this morning last time I looked. So it was down about 1.75%, something like that. But they did miss. Did not see forecasts, so I don't know if either raised guidance or not. But as far as the fourth quarter goes, they weren't bad quarters, especially in the case of Morgan Stanley. Really nice quarter. All right, let's go ahead and wrap up with the three you must see. First, I want to pull up Illumina. Now, before I look at the chart, I just want to show you Illumina over the last 20 years. This is a seasonality chart. January typically is very strong for Illumina. Goes up 70% of January's. Averages going up 11.5% during the month of January. This was one of the stocks that I gave out to our members in our seasonality report. You can see so far, it's gone down, it's come back, but I do like this AD line breaking out. It's in the biotech space. It has not been a very good stock within the space, but I think the space might give it a lift. I really liked 3 of the last 4 days with those solid hollow candles. I'm looking for Illumina to make a little move here. The number one seasonality stock I provided for members for January is Netflix, and it has been true to form. Beautiful January so far. We were around 290. Now we're 332. Really big move up. Netflix reports later this week, so be careful there. And then the last stock I have for you is not seasonality related, but just a stock that's been performing great. I've talked about the gambling stocks over the past few months, how they've been gaining steam. Look at Las Vegas Sands. Beautiful move up. AD line looks great. Relative strength looks great. I see this one going higher. Any kind of a pullback to the 20-day looks good. All right, that's it for me. Remember, tomorrow night over at Earnings Beats, we've got our model ETF draft. If you want to see how we put together our ETF portfolio, then you can scroll down, become a free member. That'll get you to our public events, but tomorrow is member only, so you'll need to actually start a 30-day trial subscription if you want to join me. Everybody have a great day. Happy trading.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're going to bring you daily content from an incredible collection of technical analysts and financial experts.